I'm running a new camera. I hope that this looks good. I don't know if it does. Here we go. Okay, I want to talk about Elliott wave principles. I've been reading this book, and it's curious because it's not actually like Mr. Elliott writing it. So I don't know how much I really trust it because it's like already one step removed, but I guess you can't get it any closer. Bukowski says this is the authoritative source for Elliott wave. And towards the end, they start talking about being at the end of a 5 wave and how things like the fall of governments and the failings of currencies could cause this massive decline. And they've got modern history mapped out from the 1700s to present using their Elliott wave principle. And I don't know, it seems like you just couldn't get enough data to be consistent enough to even start to try to make a narrative like that with it. It just seems like such a stretch. So I think my real takeaway here is just wave construction and how correction works in larger trends. So the 5 wave form, the motive wave, that's good. The corrective wave, the 1, 2, 3, the zigzags are pretty important too. I feel like when we get into zigzags, I just forget about, I just lose track of it, right? And I just start going to 1 degree higher and seeing this simpler pattern because it really does just all fractal. And it really is, it feels like I'm looking into a kaleidoscope sometimes and I get kind of lost. But to be honest, I think wave construction is the best thing, especially the nuances between actionary waves and reactionary waves, because waveform can form divergences there, and that can help you find and spot reversals. And I'm pretty sure I'm learning what kind of Elliott waves form which patterns, like truncated fifths becoming double bottoms, for instance, or these triangles, these pennants, they can be leading diagonals, they can be anti-diagonals. And I'm going to start really fine-tuning my chart pattern analysis because I think ultimately I actually do favor Bukowski chart patterns over Elliott wave, because the difference is that Mr. Bukowski has run statistical analysis with software that scans for patterns. And with that data, he can actually make probabilities of specific price movements based on pattern. And that makes sense because they're based in Elliott waveform principles. So I feel like Mr. Bukowski has refined the Elliott wave stuff. I really do. I mean, let's look at some charts and I'll talk about what I'm seeing here. Why I'm a little on the fence about Elliott wave in its entirety. I think there are some great things to get from it, of course, and it is very valuable, but that it's not the end all be all. Let's see, on this time frame you can't see anything. So this is SPX. This is not the ETF SPY. Let's pull up monthly maximum. Here we go. And let's just clean up this chart a little bit. Sorry about that. I didn't know that my rollover lines and my years were on. So here we go. So in this book, the authors give us some charts, and they describe wave 1 and wave 2, cycle waves 1 and 2 as starting ending here, and then they wrote this in 1998, which is right about here, right as the market peaked and started this big corrective phase. And this is what they were saying was the end, the end of the 5 wave. So this Elliott wave form here is based on the analysis done by the authors in 1998. And so this is where they were saying we would see the fall of governments, the collapsing of currencies, that kind of thing. And it's hilarious because, the first top was what? 2000? So Y2K fear, right? Remember that? I remember that. And then, well, I was too young really, but I do remember that specific New Year's. And then we also have this second top over here, and this was in 2008. Right? So these were two big points in history where we thought the world was going to end, and it was like, oh my goodness, get your bunker built, right? And then like the market bounced both times. And then it moved to all-time highs, right? And we know that the Fed intervened, and you know what? That's the point of the whole system, is that it can be controlled, and the markets don't have to go into an abyss. right? They don't have to. And in 1998, the authors were in that mindset. And guess what? They were wrong. No way. So it's just not the end all be all for me in forms of future predictions or forecasting, but you can clearly see that the waveforms do appear, and it's a great way to understand how the price is moving. And really what I would do, this is what I would do, is if we were to see a wave 5, because I have two big consolidations here, I'd push cycle wave 5 to the top out here to our recent high, and then make actually the end of corrective wave 4 here, this broadening, right angled and broadening formation, the end of wave 4, and take wave 3 and put it up here, and then wave 2 can move here as that megaphone top, which wave 1 topped. And that would make sense because the waveforms are consistent, so this doesn't create any divergences there as far as I know. So the rules would still have to apply, right? So wave 3 can't be the shortest wave. And so let's just say that the bottom of 2 here is at 61 and the top of wave 3 is at, wow, 1,560. So we'll call it an even $1,500. Okay, so is 1 even that tall? No, it's not. So this works. 3 is not the shortest actionary wave here if this is the full 5-wave pattern. And wave 4 does not overlap wave 1, so that's another bonus there, right? And then I believe that we're supposed to have some sort of different patterns between different waveforms between the corrective phases. So here we had a really clean megaphone, right? It has this very specific form to it where it has these corrective waves going back and forth 5 times, and then a breakout. And this would be a reverse triangle in the Elliott wave pattern speak, and then this one would be an ABC correction. And you can see these are different chart patterns too. So I would say that works for me. That works for me personally because this pattern does not fit the criteria to be a reverse triangle. And so if that could be the end of wave 4, wave 5 would have its push up, right? 1, 2, and then we subdivide through the third wave. 1, 2, 3. That's a huge wave. 4, 5. Okay, then 4, and then 5. And then the recent high would be the top. The very beep top. And that's why Elliott waveform analysis doesn't always work, is because it can fractal on and on and on and on, and it doesn't have to stop at any particular time, right? This could all just simply become a bigger 1, and then we come down and retrace down to 1500 even, and that would be 2. And then guess what? We would start a third supercycle wave, and that would be by nature probably bigger than the first one. And then the 5th wave of that cycle would be probably the equal amplitude to the first one, and it's just like up and 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 up. That can happen, right? And then this is just fractaling 1 and 3 over and over again. Of course, there'd be more cycling the smaller you go. So that's why I'm not like, this is the end all be all. So let's just take that into context and let's have a look at the weekly chart and have a peek see, because we recently had another one of these reverse triangles or megaphone tops, and it does follow the specific ABC correction waveform all along the way. You can just, it's nuts how clean it is too. See, now I'm going to be using that kind of knowledge, so when I look for my chart patterns, it's not just how many touch points can I get on a trend line, it's how were those waves formed, and that'll give me a clue into the indication of the breakout. So anyway, you do have this big throw. There's, I believe there's a trend line through here, and that trend line is somewhere below the very peak here. And this is actually a throw over, and now we're coming back down to that channel and probably going to move down towards the bottom of it. Because if this is a corrective phase we are now in, having topped, I might even have this labeled. I don't. This would be the first A, B. Whoops, I'm sorry. This would be A. That's the start of the first run. That's A, B, and then C. And you can also see that this fractals a little bit, that there's an ABC movement inside this one too, right? Isn't that nuts? 1, 2, 3. all part of 1, 2, and then 3. Boom. And we got a pretty good clean move down, didn't we? So now we have this big dump from last week, and that makes me nervous. It really does, because the measured move down, it's probably done, right? Right? Let's see here. If we get a full extension, we get a full measured move. I'm just going to draw that line, okay? I'm going to delete this one too. Really. What's my time at? 10 minutes. Okay, cool. I'm going to try to keep this under 30. I'm going to duplicate this guy right here. I'm just going to take it and put it to the top. So boom, right down there. Yeah, you can see that this is the bottom. This is the bottom of the measured move. And so this is a great time for the markets to reverse. Now, here's the danger, right? Because if it's not time for it to reverse, because this is Elliott waveform, it doesn't predict a bottom here. It predicts a continuation of patterns. So I think that it's possible that, and this is going to sound nuts, all of this motion here, this is actually all 1. And we're now finding ourselves in a 2, okay? So let's have a look at these. This was a 2-week topping pattern. And this was a 3-week topping pattern. Let's get a 4-week topping pattern going. And then let's just duplicate this drawing right here. And say we could have an even bigger ABC correction than we might even have bargained for. Okay, now I'm just going to delete these smaller waves. This can happen. Yeah, that looks good. And that brings us right into the top of wave 4. Ha! Nice. Nice. That looks good. I mean, it looks like a stock market crash. Yeah, that's true, but it's not. It's just a corrective phase. Yeah, that'd be nuts, huh? Whatever trend we're in now, it's not the degree of 1 point higher is not corrective. If it was corrective and we were going down in another corrective wave, that corrective wave would take a motive wave form, and that's how you know when you can get a big reversal there, because when the reversal occurs in 2 degrees at the same time, that's boom boom time. That's boom boom time. Multiple waves making different moves. So yeah, we could be done. This could be done, or we're going way down to 3,500, and we're going to get the answer as soon as we see the price start dropping again below slow, before it, as it passes that low of 38.10, 32, 38.10. That's going to be, hey, it's pain train time. It's going to hurt. Now, this is interesting. 1, 2, 3, 4, 5. Or 1, 2, 3. And 1, 2, and this is 1, 2, 3, 4, 5. That was an extension. And this is wave 4. And this is 1, 2, this was the wave 3, right? And it's subdivided into 1, 2, 3, 4, and this is the bottom of 4, right? So wave 4 comes down to the 4 of the previous subwave, and then now we're going for 5. Yeah, we're going for 5. So this move down though, this move did take a motive wave form. So what's going on in 1 degree higher here in this move down is actually down. Okay, so what that means is this run could be leg 1, 1, 2, 3. Wait, 1, 2, 3, 4, and that can't be 5 though, right? So this is a motive wave taking corrective wave form. That's a divergence. And guess what? That marked the top of the market. So suddenly you had a corrective wave downward, and it became known as a motive wave when the next wave that followed it moved in the same direction but swapped. Or it's the other way around, right? No, it's not the other way around, because this being an actionary wave, is a big deal because this was a reactionary wave. This was an actionary wave. Whew. Interesting, right? Interesting. So 1, 2, 3, 1, 2, 3, 4, 5. And if that's true, if this is 1, 2, and we're on 3, okay, so let's just assume 3 extends. 1, there's the first one, and then we're going to subdivide 3 into 2, and now we're going to be on the 3, the third subwave of the third motive wave down. If it's not a reversal. If it doesn't reverse, it's going to go down, way down, like, wow, so far down. If it doesn't reverse. And the Fed is going to move the markets this week, you know? They could do what they did in 2008, right? They could do the same thing and just be like, nope, up you go, and it could happen. And it would be fantastic. That sounds like Moaz to me. I'm not a Moaz hyper, but what if, I don't know, what if the short interest was like a safety net, right? Like a safety net. Hey, we need to bail out the market somehow. How do we do it? Maybe we can come to some agreement. I'm not alleging anything, but I'm just saying that, you know. It's pretty ingenious if you think about it. It's pretty ingenious. And the banks have bailed out the United States before. It has happened in history. There's a book here I like to read. It's called The Great Game. Charles Payne suggested people read it, and so I did, and it blew my mind. So anything can happen. You read that book, you understand anything can happen. And I'm not a Moaz hyper, but it's like, let me go look at AMC real quick, because this is also supposed to be about AMC. So I did some analysis, and I think that the push from 191 to 72.62, I think that was a motive wave 1, and it had a truncated fifth before falling, and we've just come these measured moves down that I followed and I saw fractaled and studied. I didn't even know that was Elliott wave, but I saw the pattern myself and applied the analysis, and it worked. So maybe I show that really quick. I didn't know this was Elliott wave, but it is. So this was what I called the third measured move down, because qualitatively it matches some other corrective trends. Primarily, you have this big one, you have a double bottom, right? And there's bullish divergence there in the RSI. And then there's an uptrend formed by that bullish breakout from the divergence. When that breaks, there's an internal trend line that breaks, and that confirms the next move down. So this was the third one. And that was just, you know, I know I'm looking at corrective trends now, right? Like, look, this is point B. This is point B. Let me pull out the Elliott wave analysis. No. Oh, that's A. That's the first one. B, C. I'm finding the, yeah, so this is cool. Let me go back to let's go to the next measured move down. Here's the second one right here. And, the first one's going to be even smaller inside of it. Right. And so you can see how that fractaling worked. First it's this little blob, then it becomes this whole blob, then it's this whole blob, and then it could be even bigger. Let's see here. Do I have it? Doesn't look like I have it. But the idea is that this is all 1, 2, and now 3 is going to be like the floor. But that doesn't make as much sense to me anymore because of the Elliott wave analysis. But yeah, so basically these measured move down, I've just been watching them, and I think they're done. I think we're done correcting, and I think that the meme stocks are kind of turning into leading indicators for the market. You know, AMC didn't drop as much as other indexes, or as the index funds did. Instead, it looks like we started carving out a bottom, looking to confirm C, and if Monday we get that, right, then this will be the beginning of a third subwave, of a third wave, which is a big wave, a big push up, I'm still not bearish yet. We got to take out this low at 1177 first. Then it's okay, let's talk about being bearish, I guess. But this looks actually much more like reversal. You see this 5-wave forming in, because it's actually a small corrective trend within a 3-wave, and it's the second wave. And so that's what I mean by third wave of third wave. So I'm excited because I think that there really could be some upside here. Of course, that's pretty much banking on the Fed sending the markets higher. And I think we can trust that. I think we can. We probably have had a recession. We're probably in a recession. It takes 9 months to know if you're in a recession. The first one takes 3 months long, and then you have to wait 3 months for that data. And then 6 more months go by before you get that data. Right? It's like, it takes forever to figure out you're in a recession. And it's possible that it'll be over next year. Wouldn't that be funny? If like we had a recession and it was already over and the markets were pushing to all-time highs, no one would ever see that coming, right? But it could happen. It could happen. If it doesn't happen, it's going down. It's going way down, and I'll flip bearish when we get there if it happens. So that's kind of where I'm at with my Elliott wave analysis study and how I think the S&P is doing and what that could mean for AMC. I hope that this looks good on video and that the new intro came out pretty good too. If you like the content, please subscribe. I'm excited moving into next week. I'll see you then. Happy trading.